Welcome to Smart Wealth with Joshua.
Your daily stock analysis and catalysts talk. Today, we're looking at SpaceX.
If you find our talks useful, please consider subscribe, like, and comment underneath. It really helps out. And before we get to the actual hook for today, I do want to mention StockOracle.
Right, which is an AI-aided stock research platform we use.
Yeah, and there is a special 14-day trial link below in the description.
Just a quick heads up, though, that is an affiliate link.
Exactly, so the channel may earn a commission at no extra cost to you.
And we always have to remind you, StockOracle is an AI tool, not financial advice or, a trading signal service or real-time market data.
Right.
And their AI insights and valuation estimates can be incomplete or wrong. So please, always verify important facts yourself.
Always. Okay, so imagine you just bought a ticket on a state-of-the-art rocket.
Okay.
The countdown finishes, the engines ignite, and then boom, it just explodes right on the launch pad.
Absolute disaster.
Right, absolute disaster.
Yeah.
But as you're turning around to leave, in total disappointment, you notice something really strange. All the lead engineers, the people who actually built the rocket.
The ones who know how it actually works.
Exactly, the ones who know every inch of the circuitry. They're quietly rushing to the ticket booth to buy up all the remaining seats for the very next flight.
Wow. Yeah, that completely shifts your perspective.
Yeah.
You go from thinking the whole project is just this catastrophic failure to wondering, oh, wait a minute, what do they know that I don't?
Exactly.
Yeah.
And that is the exact scenario playing out right now in the financial markets with one of the most anticipated companies in history. We are looking at an absolute behemoth today.
Yeah, a massive one.
A $1.54 trillion titan that just completed a record-breaking IPO in June of 2026. We are talking about SpaceX, trading under the ticker SPCX.
It's honestly just a fascinating moment to examine this company. I mean, the sheer scale of the valuation and the resulting market chaos is, well, it's largely unprecedented in modern aerospace.
So here is our mission for today's talk. We're going to look at the post-IPO financial data, unpack some highly speculative rumors currently floating around Wall Street, and examine the upcoming catalysts.
Because right now, looking at the chart, the stock has been slashed by nearly 50% since its IPO.
Yeah, to the average retail investor, it just looks like a falling knife.
Yeah.
But underneath the surface, company insiders have quietly scooped up almost 3.5 billion shares.
Billion, with a B.
With a B. So we're going to help you figure out what is driving this extreme market volatility and determine if this is a classic bull trap or, a very rare entry point into a literal aerospace monopoly.
The contrast between the public market reaction and that massive insider accumulation is really the core mystery here.
Yeah.
Because to understand why a company with this level of unparalleled market dominance is taking such a beating, we really have to pull back the curtain on the numbers.
Right. So looking at the tape today, they're hovering around $116 a share.
Which is a slight rebound.
Yeah, a slight rebound from a 52-week low of about $108, which they just hit on July 27th. But the real context you need is that it's sitting nearly 50% below its high of $225.
It's a massive haircut.
Huge. The year-to-date return is sitting at roughly negative 29%. And yet, despite that massive drop, the price-to-book ratio is still sitting at an astronomical 37.14.
Yeah, and if we connect this to the bigger picture, what we're witnessing is the anatomy of a classic post-IPO hangover.
Right.
When a company with this much institutional hype and, frankly, cultural cachet finally goes public, you get a massive influx of retail enthusiasm.
Everyone just wants a piece of the future.
Exactly. And that creates this temporary froth, pushing the valuation to completely unsustainable short-term heights. So what you're seeing now is that froth being violently purged.
The hangover.
The hangover, yeah. And it sets up a potential mean reversion where the stock price eventually snacks back to reflect the actual underlying business metrics rather than just pure hype.
Okay, let's unpack this, though, because I want to look at that price-to-book ratio of 37 again.
Yeah.
It's high.
It's crazy high. For a normal, healthy industrial or tech company, a standard PB ratio might be anywhere from 1 to 3, maybe 5 if it's growing fast.
Sure.
And a PB essentially tells you how much you are paying for the company's net assets.
Right.
So at 37 times book value and with zero focus on paying out dividends or stock buybacks, aren't retail investors essentially paying a massive premium for a company that expects them to wait like a decade for an actual payout?
Right.
Feels like buying top dollar farmland. You're paying premium real estate prices today, but the farmer's telling you, hey, Don't expect to harvest for another 10 years because I'm taking all the seeds and using them to plant more fields.
I mean, the farmland concept makes sense for the waiting period, but it's actually more extreme than that.
How so?
Because you aren't just paying for the land, you are paying a premium for the intellectual property and the infrastructure of a monopoly.
Oh, okay.
The market is pricing in the assumption that this specific farmland will eventually be the only one producing food on the planet.
That's a good way to put it.
But look, your skepticism is absolutely warranted. Traditional trailing 12-month metrics like PE ratios and earnings per share, they're listed as not applicable right now.
Because they just don't operate like a legacy company trying to return capital to shareholders next quarter.
Right. Every single dollar of free cash flow is being aggressively channeled back into next-generation launch capabilities and expanding the Starlink constellation.
Yeah.
I mean, the ultimate goal is to capture the entire global broadband market.
And that aggressive reinvestment is the engine of their famous business flywheel.
It is the defining mechanism of the company. The flywheel starts with reusability.
Right.
By landing and reusing the Falcon 9 boosters, and now pushing the development of the fully reusable Starship, SpaceX fundamentally alters the economics of spaceflight.
They make launches incredibly cheap.
Exactly. Because their internal launch costs are so low, they can rapidly deploy thousands of Starlink satellites at a fraction of what a competitor would pay.
Which then creates the Starlink mega constellation, bringing in monthly subscription revenue from all over the globe.
Which generates massive cash flow. And where does that cash go?
Right back into R&D to build even bigger, cheaper rockets.
It is a continuous self-feeding loop. Add in their vertical integration, meaning they don't rely on a massive web of slow subcontractors.
Right. They build everything in-house.
Everything from the rocket engines down to the user terminals. That creates a structural moat that legacy aerospace companies simply cannot cross.
But look, if that flywheel is so unstoppable and retail investors are getting washed out because they can't stomach the 10-year waiting period, it makes no sense that the people with the most to lose, the insiders, are doubling down.
Yeah.
So let's look at exactly what they see in the internal ledgers.
Because the quantitative data here tells a very, very different story than the stock chart.
Yeah, looking at the squeeze watch indicators, there has been a net insider buying of roughly 3.5 billion shares across just 6 transactions in the last 90 days.
That is massive volume.
And that gives them an insider sentiment score, or MSPR, of 96 out of 100.
What's fascinating here is the actual mechanics of how that happens, because you don't just, log into a retail brokerage and click buy on 3.5 billion shares.
Right. That kind of volume would instantly spike the daily price and ruin your average cost basis.
Exactly. So how are they doing it? These are likely executed through dark pools or negotiated institutional block trades off the open exchange.
Oh, wow.
Yeah, they are strategically accumulating these shares in massive tranches. And an MSPR score of 96 is exceptionally rare.
Because it means out of 100 possible data points measuring insider confidence, 96 of them are flashing bright green.
Right. This cluster buying is happening right at the 52-week lows. This isn't management just throwing darts, hoping for a dead cat bounce.
Yeah.
These are the people who see the actual Starlink subscriber growth, the proprietary R&D breakthroughs, the things that aren't public yet.
Actual internal ledgers.
Exactly. For them to orchestrate the purchase of nearly 3.5 billion shares at these depressed levels, it's a signal of ultimate confidence in the intrinsic value of the business.
So going back to the exploding rocket analogy, the engineers are basically buying all the seats in the dark.
And we are seeing technical indicators confirming the shift, too. The current trading volume is sitting at only 0.55 times the 10-day and 3-month averages.
So the daily trading volume has essentially been cut in half.
Yep.
Why is that a good thing if the stock is down?
Well, it creates what technical analysts call a bullish divergence.
Yeah.
Usually when a stock is crashing, you see massive volume. Everyone is rushing to the exits in a total panic.
Right, the volume spikes.
Exactly. But here, the price has drifted down to the $108 to $116 range, and the volume has just dried up.
Interesting.
Mechanically, that suggests selling exhaustion.
Meaning the people who wanted to panic sell have already sold.
You got it.
Yeah.
There is almost no one left to push the price lower. When downward momentum dries up on declining volume, while insiders are simultaneously scooping up shares in the background, it often signals a floor is forming.
And Wall Street is definitely catching wind of this. I mean, Raymond James recently issued a price target that some analysts are calling outright absurd, basically doubling down on the stock, despite the 50% post-IPO haircut.
Yeah, they see the underlying value.
But the really wild note came from RBC, highlighting what they call trillion-dollar chip savings.
Now, the RBC note is where the narrative fundamentally shifts.
How so?
Because we have to stop looking at SpaceX as just an aerospace company or even just an internet service provider with Starlink.
Right.
RBC is synthesizing the idea of orbital AI integration.
Okay, wait, explain that.
They are projecting that SpaceX could actually be building a massive orbital computing and AI infrastructure play.
Here's where it gets really interesting, because the rumor mill on this specific concept is in absolute overdrive right now.
Oh, yeah. Big time.
If you look at prediction markets like Kalshi right now, they're giving a 68% probability of a formal SpaceX and Tesla merger before 2028.
Wow.
Yeah, under a new umbrella they're calling SpaceX AI.
I mean, it is a staggering concept if you break down the mechanics of orbital compute.
Walk us through it.
Think about the biggest bottlenecks for AI right now. It's massive energy consumption, cooling the data centers, and latency.
Right.
Well, if you put data centers in low Earth orbit attached to the Starlink backbone, you basically solve those problems.
Because of the environment in space.
Exactly. You have unfiltered 247 solar power. Space is naturally near absolute zero, so your cooling costs just vanish.
That's crazy to think about.
And by beaming data via lasers between satellites, you bypass the terrestrial fiber optic grid, creating the lowest latency global network possible.
So the merger math here is combining Tesla's world-class AI and manufacturing prowess with SpaceX's orbital infrastructure.
Yep.
Basically creating a decentralized supercomputer in space.
That is the speculative thesis driving the Raymond James and RBC excitement, yes.
I do have to push back here, though. Merging Elon Musk's two biggest entities sounds like a fantastic sci-fi movie script on a prediction market. But how much of this current $1.5 trillion valuation is resting on the mere hope of these magical AI synergies, rather than actual tangible satellite revenues?
That's a fair question.
Because we all know how dangerous it is for a retail investor to trade on unconfirmed M&A rumors. You can lose your shirt.
Well, I wouldn't call the tech magical, but your caution is entirely justified. While a formal M&A announcement of that magnitude would be a historic catalyst, a trillion-dollar valuation built solely on rumor is incredibly fragile.
Right.
The real foundation has to be the tangible business metrics.
Which means we need to step away from the Kalshi prediction boards and look at the actual calendar. What are the reality checks approaching the event horizon in the next 3 months?
The most immediate one is right around the corner. On August 4th, 2026, SpaceX is scheduled to report its very first quarterly earnings as a public company.
Man, going into a company's first public earnings report is always like flying blind.
Ton.
There is no historical baseline for how management handles the call, how they guide expectations, or even how the market algorithms react to their specific accounting.
And the scrutiny is going to be intense. Institutional investors aren't going to care about orbital AI dreams on this call.
They want the hard numbers.
Yes. They're going to demand hard numbers on Starlink's subscriber growth, the profit margins on their commercial satellite launches, and concrete forward guidance on when the Starship platform will be fully commercialized.
And if management can validate those hypergrowth expectations, it could be the spark that ignites a rebound.
Exactly.
But we also have macro events trailing right behind earnings. There are major follow-ups scheduled for the S&P Global Space Conference.
Right.
We're seeing data that space tech investment is surging, largely driven by SpaceX, proving the market is even viable.
It's opening the floodgates.
It really is. And that conference is going to be a hotbed for actual signed space deals and further development of that orbital AI architecture we just talked about.
But, arguably, the most critical catalyst isn't technological, it's regulatory.
Yes, the FAA and the U.S. Transportation Department, which is currently under the Trump administration, they're proposing sweeping rules to grant environmental review waivers for commercial rocket launches.
Now, to look at this objectively, and regardless of where anyone stands politically on the merits of environmental deregulation, we really have to look strictly at the P&L, the profit and loss impact on the business.
Right, and to be absolutely clear for you listening, we are not taking a stance on the politics or endorsing the policies either way.
No, absolutely not. We are purely analyzing how this proposed regulatory change impacts the math.
So operationally speaking, what is the actual mechanism here? How does a policy change like this move the stock?
Bureaucratic and environmental reviews are currently the major bottleneck for SpaceX's launch frequency.
Okay.
I mean, they can build rockets faster than the government allows them to fly them.
Oh, okay.
So if those waivers are finalized, it effectively slashes the red tape. That immediately boosts their launch cadence.
And more launches per month means faster deployment of the Starlink network.
Right, which means lower operational overhead per launch and accelerated revenue.
Got it.
It acts as a massive accelerant to that flywheel we talked about earlier.
Okay, so we have 3.5 billion shares of insider buying. We've got potential regulatory tailwinds to speed up the launch cadence, and an earnings call that could mathematically prove the business model.
Yeah.
It sounds like a coiled spring. But we promised a reality check today, which means we have to talk about the bear case.
And the bear case here is heavily rooted in extreme volatility.
Right, looking at the risk metrics, SpaceX carries a beta of 5.886.
And this raises a very important question for anyone listening who is thinking about taking a position. Can your portfolio actually stomach the ride?
Well, explain the mechanism of beta for a second, just so everyone is on the same page.
Sure. So it's a measure of a stock's volatility relative to the overall market. The S&P 500 has a beta of 1.
Right.
A beta of nearly 6 means that SPCX is approximately 6 times more volatile than the broader market.
So if the S&P 500 drops 1% on a bad macro day, say, an inflation report comes in hot, SpaceX could theoretically drop almost 6% in a single session, just based on its beta weighting.
Easily. The price swings are going to be violent.
Yeah.
And when you combine a stock that is mathematically 6 times more volatile than the market with that massive 37.14 price-to-book ratio, the stock becomes highly vulnerable to something called multiple compression.
Multiple compression, meaning the broader market suddenly decides it's just no longer willing to pay such a high premium for the assets.
Exactly.
The underlying business might still be fine, they might still be launching rockets, but the stock price just plummets to align with more traditional, boring valuations.
Precisely. Because if the August 4th earnings report shows that Starlink growth is even slightly slower than expected, or, if those FAA waivers get stalled in some bureaucratic lawsuit, the narrative shifts overnight.
The market just won't wait around for the 10-year harvest.
They won't. They will punish the stock, compress that 37x multiple down to something much lower, and that 50% post-IPO drop we've seen so far.
Yeah.
That could just be the opening act.
Man. So what does this all actually mean? Let's put ourselves in the shoes of a swing trader looking at this today.
Okay.
The quantitative sentiment scoring gives this setup an 8 out of 10 bullish score. Analysts are categorizing it as a genuinely rare entry point into a dominant aerospace monopoly.
They are.
But you have to ask yourself, is that 8 out of 10 score worth the stomach-churning 6x volatility risk, especially when you are walking completely blind into a company's very first public earnings report?
That is the ultimate tension of this entire setup. I mean, the fundamentals of the underlying business are structurally sound. The technological moat, the reusability flywheel, the vertical integration.
Yeah.
But the market dynamics trading on top of that business are chaotic and, frankly, unforgiving.
It is a massive amount of data to weigh. So let's do a quick recap of the journey we just took. SpaceX right now offers a potentially historic long-term opportunity. You have the chance to buy into a dominant aerospace and telecom monopoly at a 50% discount from its post-IPO high.
Right.
The management team clearly believes in the underlying value, given the massive multi-billion share insider buying orchestrated at these 52-week lows.
Which is a huge signal.
And there are potential regulatory tailwinds on the horizon that could just pour gasoline on their launch cadence.
But on the flip side of that coin, we just said, you are taking on extreme beta risk.
Yeah.
You are buying into a valuation that mathematically demands hypergrowth to justify its existence, and all of that hinges on the reality check coming on August 4th.
So we want to turn this over to you, the listener. What stands out to you in all of this data? Do you trust the billions of dollars that insiders are quietly spending to buy up the stock?
Or do you fear that the post-IPO hangover isn't quite over yet, and that 37 times book value is just too steep of a cliff to stand on in a volatile market?
Exactly. And honestly, it really begs a larger question.
Yeah, I want to leave you with one final thought to mull over, something that isn't really found on the balance sheet, but speaks to the psychological nature of the market itself.
Go for it.
So for years, retail investors clamored for SpaceX to go public. They aggressively wanted the chance to share in the immense wealth being generated by this modern space race.
Oh, people were begging for the IPO.
Right. But now that it is public, the immense stomach-churning volatility is shaking those very retail investors out of their positions at 52-week lows.
Yeah.
Meanwhile, the insiders who already built the company, who already have the wealth, are quietly consolidating billions of shares at a massive discount.
Wow.
It begs a rather uncomfortable question. Does taking a dominant monopoly public actually democratize wealth for the everyday investor? Or does it just create a new, highly volatile arena for insiders to capitalize on retail panic?
Wow. That really brings it all back to the launch pad, doesn't it?
It does.
The rocket exploded, the crowd is running away in an absolute panic, and the engineers are just quietly standing at the booth, buying up all the tickets for the next launch.
That's exactly what's happening.
So, if you find our talks useful, please consider subscribe, like, and comment underneath. It really helps out.
And don't forget to check out the special 14-day trial link for StockOracle in the description below.
Right, our favorite AI-aided stock research platform.
Just remember, it's an affiliate link, it's not financial advice, and you should always do your own research since AI can be wrong.
Absolutely. Thank you so much for joining us for today's analysis. Keep questioning the data, keep looking beneath the surface, and we'll see you next time.